Fortune 500 has hit the acceptance phase when it comes to artificial intelligence. Welcome back to the AI Daily Brief. Today we are discussing a recent report showing the significant increase in Fortune 500 companies talking about generative AI in SEC filings, particularly in the context of identifying risks. We're going to get into that report, but the broader context that I want to present this in is a trend that I'm seeing emerging of something of an acceptance phase on the part of businesses when it comes to AI. We're going to talk a little bit about recent market news. Like I said, we're going to discuss this report, and we're going to situate it in this larger context. And for this, I want to kick off actually with the same report that I featured in yesterday's episode, but particularly in this first line. After nearly 2 years of debate, the verdict is in. Generative AI is here to stay, and its business potential is massive. I think the way that McKinsey chose to frame this is notable, that perhaps there was some room for debate, but at this point, it's just very clear that Gen AI is not going anywhere, and it is going to have a big impact on how people do business. Now, it's worth noting that this is not a universal perspective. You can still find pieces like this one that ran in The Economist this week that actually goes so far to argue that not only is Gen AI not just in its Gartner trough of disillusionment phase, but that it's more likely that it's nothing at all and that it never comes out of that phase. Perhaps a bold prediction, but then again, The Economist doesn't make anyone put their name on anything, so we're not going to be able to harangue them for years and years and years about this terrible prediction. Still, I really don't believe that that's the dominant narrative right now. In fact, what I'm seeing much more are pieces like this one from Mark Minovich in Forbes. The real AI revolution has just begun. You're starting to see this notion that perhaps, yes, we are moving past the peak of inflated expectations, to use the Gartner term, but in this trough of disillusionment, we're already seeing glimpses of where people start to figure out what it really means to integrate AI. And so keep that in mind as we look at some of these recent stories. First of all, there's something of a normalization, I think, when it comes to analyst expectations. One of the things that I've talked about a lot is that it's really important to be able to separate Wall Street questions of AI valuations and AI's hype as a business tool and as a powerful technology in general. These are two separate things. Still, when it comes to the market side of things, this Reuters piece is titled, S&P 500 to end 2024 near current levels suggests AI rally fizzling out. And I think it's important to remember here that literally since the tightening cycle began, which coincided with ChatGPT being released, AI-related excitement has been the thing keeping the stock market afloat. It has been the bulwark against larger stock instability, and at some point it was inevitable that it was going to wane. We've seen that waning for a couple months now, but this is sort of a softer framing. This isn't about some big bubble bursting. It's about fatigue with enthusiasm, which I think is a much more likely outcome. The story focuses on a Reuters poll of market strategists that effectively says that the focus of investors is moving away from AI and what it's doing and towards the beginning of Federal Reserve rate cuts. Once again, this makes sense if you view the boom in AI stocks as somehow tied to the tightening cycle. Now that we're returning to a rate cutting period, emphasis is moving back in that direction. Of course, one of the big questions when it comes to Wall Street and AI is how much the big tech hyperscalers are spending on infrastructure and AI build-out, as opposed to how much money they're making. But even this is a somewhat confusing story. On the one hand, it is undeniable that these companies are spending gobs and gobs of money, and are doing so fairly unrepentantly, basically all arguing some version of the same thing, that it's a lot more dangerous to underspend right now than it is to overspend. At the same time, it's not like we're seeing no results. The most recent example is summed up by Axios, who writes Meta's ad biz booms with AI. In the first half of 2024, each Meta employee on average accounted for more than $1 million in revenue, which was a company record. In the Why It Matters section, Axios writes, Meta made steep cuts in late 2022 and early 2023, but they haven't impacted its business growth, thanks in large part to AI-driven improvements to the social media giant's recommendation system and ads platform. There is a sense that in the 3 years subsequent to Apple's privacy changes in 2021, Meta made a big bet on changing the nature of its ad business. Axios writes that today, all of Meta's millions of advertising clients use at least one of their AI-driven ad tools called Advantage Plus, which help advertisers choose targets, optimize placements, and increasingly also even help with content creation. Since 2022, there's been a 12% increase in the return on ad spend for Meta advertisers. The bottom line, according to Axios, and something that Wall Street has to take into consideration is, quote, Meta's business might never have recovered from Apple's 2021 changes and 2022's advertising industry slowdown if it hadn't rebuilt its recommendation engine and ad platform around AI tools. And clearly this is just the beginning, as their big Gen AI build-out on AI creative content for advertising continues. Said Zuckerberg back in July, Over the long term, advertisers will basically be able to just tell us a business objective and a budget, and we're going to do the rest for them. Now, speaking of the company on the other side of that story, Apple, part of the reason that analysts anticipate a sideways sort of movement for the end of the year is that markets have had a chance to digest some key information, including Apple's launch of Apple Intelligence. Yahoo Finance writes Apple has enormous expectations in its AI-tied valuation, which basically highlights that analysts have priced in Apple's AI initiative being a big success, which creates a lot of pressure on them to perform. What you'll notice from all of this analysis is that it's much more specific, it's much more discrete, it's much more middle of the road, it's much less focused exclusively on AI as opposed to a combination of factors, and all of that, like I said, leads to something of a feeling of a normalization when it comes to the AI narrative on Wall Street. Behind the scenes, however, speaking of normalization, it's very clear that the Fortune 500 is taking the changes that are being wrought by AI very seriously. Fortune highlighted this Arise study, The Rise of Generative AI in SEC Filings, calling out the fact that the number of Fortune 500 companies flagging AI as a risk has soared by nearly 500%. 56.2% of companies in the Fortune 500, 281 companies in total, have highlighted AI as a possible risk factor to their business. That's up from just 49 companies last year. So which companies have most identified AI as a risk? At the top of the heap is media and entertainment, where 91.7% of the Fortune 500 in that area flagged AI as a risk. That was followed by software and technology, where 86.4% categorized it as a risk, 70% for telecom, 65% for healthcare, 62.7% for financial services, and so on and so forth down the line. Automotive was the company that least identified AI as a risk with only 18.8%. Now, what were the types of risks identified? The report suggests that they fall roughly into 4 categories. The first is competitive risks, basically failing to keep pace with competitors or achieve AI goals. So, for example, Netflix wrote, "New technological developments, including the development and use of generative AI, are rapidly evolving. If our competitors gain an advantage by using such technologies, our ability to compete effectively and our results of operations could be adversely impacted." A second category is general harms. This includes things like ethical issues or controversy that arise from the use of AI. A third category is regulatory risk, which basically all reflects the fact that there aren't necessarily clear rules yet, and the unknowns there create their own type of risk. And finally, there are new security risks. Now, interestingly, even though such a significant number of companies are identifying the risks from AI, a much smaller percentage are citing the benefits. Only 30.6% of companies that mention generative AI cited its benefits or use outside of that risk factor section. The Arise report points out that in general, part of these filings is to err on the side of disclosing more rather than fewer risks, but that this still seems like a missed opportunity. I think it's more than a missed opportunity. I think it reflects the fact that on the one hand, companies have embraced the idea that AI is going to change things, but haven't yet got to the point of actually figuring out what to do with it. This gets back to that report that we described in detail yesterday about how basically employees are racing out ahead of their firms when it comes to using AI, and that the obvious next development is for firms to try to actually get value on organization-wide business-level objectives. So the point that I'm trying to make with this is that when you have a 500% increase in the number of firms that are discussing AI with their investors and recognizing its real potential to change the nature and context of the business environment they work in, we may be quote unquote beyond the hype, but that's really only because we are fully into the acceptance phase. Anyway, interesting stuff here. I will continue to track these narrative trends. For now, though, that is going to do it for the AI Daily Brief. Thanks for listening or watching as always, and until next time, peace.